Is your call a foreign call or is it a domestic call?
It's really a domestic call mostly. That's the main driver here. I mean, first quarter had a lot of noise in the trade statistics. I think some of that is going to unravel. But I think it's really about higher interest rates, lower stock prices, somewhat wider credit spreads, and to some degree the appreciation of the dollar. But all of those different drivers, which are primarily going to impinge on domestic demand, slowing growth to a much lower pace.
Do you see any indications at this time that the labor economy is easing? Is it in the micro data that you look at every week?
Not yet in the data, no. I think there are some signs in the more anecdotal reports, company by company reports, some of the tech firms scaling back hiring, lowering open positions. In the hard data that get published by the Labor Department, not yet.
Jan, how high does unemployment have to get to reach that sort of spare capacity that you're looking for in the labor market?
I actually don't think that the unemployment rate has to rise a lot. What needs to happen, I think, is that companies bring down open positions. So the path that the Fed's targeting is to slow growth to a pace that is slow enough for companies to shelve some of their expansion plans and bring down some of their open positions, but not so slow that you start getting large numbers of layoffs. So we're expecting a little bit of an increase in the unemployment rate from the 3.5% range to the 3.75% range, but not a large increase.
Do you think that basically Michelle Meyer was correct when she was talking about the ability for consumers to lever up even if their incomes aren't keeping pace with the inflation rate right now, and that basically the Fed has to go a lot faster even still than people seem to think in order to slow that? Otherwise, we're going to get even more overheating.
Well, I think borrowing is going to be a short-term driver of spending, and I think has been to some degree. If you look at the consumer credit numbers over the last couple of months, there clearly has been some, re-leveraging to some degree. But I don't think that that's going to be a lasting kind of support for spending. So I think consumer spending is going to be relatively slow. Income is going to be quite weak in 2022. We're looking for only 0.5% real income growth on a fourth quarter to fourth quarter basis. On an annual average basis, actually significantly weaker than that, but even on a Q4 to Q4 basis, only 0.5. And I think that's going to keep spending pretty soft.
Long ago and far away, there was Dudley and McKelvey and this young whippersnapper from Germany. What was his name? I think it was Hatzius is what it was. And you codified MEW, mortgage equity withdrawal. Let me cut to the chase, Jan. When does the housing market break?
Well, MEW is actually a very important issue again. Not as important, I think, as going into the 2008 crisis, but there has been a pickup in mortgage equity withdrawal over the last year, and you've had this increase in consumer credit as well. Similar kind of dynamic. This supports spending in the short term, but ultimately is not going to be a sustainable source of big increases in spending. So builds in a slowdown sort of down the road. And I think when the housing market slows, of course, is going to determine the timing of that. We haven't really seen significant slowing in the hard data yet. I do expect it. Mortgage rates are up even more than 10-year Treasury yields.
I just ask because Farrell wants to know, should he buy in June or July?
I'm not going to give him advice on that. That I think is probably not
advice I was after, Jan. Don't worry.
That's too long term for Jan.
Jan, let's finish here just quickly. What's the biggest risk right now, to your view?
Well, I think the Fed is still trying to bring down, slow the economy, slow employment, and bring down open positions because they're still worried about inflation being too high. And it will be well above target for the foreseeable future. I do think it's going to come down. But if it doesn't come down quickly enough, we can see, still significantly higher rates. Our call at the moment is 3 to 3.25% for the funds rate. We've stuck with that, and it's fairly close to market pricing. But I think the risk case is that they have to do more, and that then also raises the risk of a hard landing. Not our baseline, but that would be the risk.